Meet Carol. She is 63 years old, retired 18 months ago after 28 years working for a school district in Ohio. She spent decades watching other people's retirement accounts. Now it is her turn. Carol has $340,000 in SCHD. That is her income engine. Every quarter, a dividend check lands in her account. She pays her utilities, her car insurance, her grocery bill. It all comes straight from that check. SCHD is the part of her retirement that feels dependable. Last week, Carol got a notification from her brokerage app. It said SCHD had changed 47 of its holdings overnight. She stared at the screen. Then she called her daughter and asked, "Did something go wrong with my fund?" Nothing went wrong, but Carol did not know that yet. And if you own SCHD, or you're thinking about owning it, you deserve to know exactly what happened, why it happened, and, most importantly, whether the income you are counting on is safe. By the end of this video, you will understand the March 2026 reconstitution better than most financial advisors. You will know what went in, what came out, and what the new portfolio actually means for your quarterly check. Quick note, I am not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, there's one detail about this reconstitution that almost nobody is talking about. It has nothing to do with oil and nothing to do with energy. It's about something much more important to a retiree, the long-term safety of the dividend itself. We'll get there. What reconstitution actually means. Before we look at the specific changes, let's spend 2 minutes understanding how SCHD actually works. Because once you understand the process, the word reconstitution stops sounding scary and starts sounding exactly right. Here's the first thing to know. SCHD does not have a manager sitting in a corner office picking stocks based on a hunch. There's no one deciding that Procter & Gamble is in and Halliburton is out because of a feeling. The fund tracks the Dow Jones U.S. Dividend 100 index, and every March, that index runs a full review. Every eligible company gets run through 4 quality screens. 1. Free cash flow to debt. The company has to generate enough real cash to cover what it owes, not just on paper, but in actual dollars. 2. Return on equity. The company has to use its shareholders' money efficiently. 3. Dividend yield. It has to be paying a competitive dividend right now. 4. 5-year dividend growth rate. The dividend has to have been growing consistently, not just in one lucky year. So what kind of companies passed the test this year, and which ones failed? The answer tells you something very specific about where the economy is heading and what smart retirees should be positioned for. Who's in, who's out, and why it matters. 25 companies were added to SCHD. 22 were removed, and the sector weights shifted in a way that's very meaningful for retirement income investors. The biggest headline is energy. Energy dropped from roughly 20% of the fund to around 12%. Companies like Valero Energy and Halliburton are out, and right now, with oil trading over $100 a barrel, that sounds like a mistake. Here's the myth. Losing energy exposure when oil is surging is terrible timing for income investors. Here's the truth. For someone who depends on this fund for monthly living expenses, the energy reduction may be the most important thing this reconstitution did, and the 4 quality screens agree. Here's why. Energy companies like Valero and Halliburton failed the consistency test. Their dividends are directly tied to the price of oil. When oil is high, they're generous. When oil falls, and it always falls eventually, the dividends get cut, sometimes sharply. A retired school district employee in Ohio can't have her grocery budget fluctuate with a barrel of crude. SCHD's screens identified that risk and removed it. Now look at what came in instead. United Health Group, Abbott Laboratories, Procter & Gamble, Qualcomm, Accenture. These companies passed all four screens. They have strong free cash flow that does not depend on a commodity price. They have durable earnings across economic cycles, recessions, pandemics, rate hikes, and they have long, consistent track records of growing their dividends through it all. Healthcare moved up in the fund. So did healthcare. So did financials and quality technology. The result is a more diversified, more defensively positioned portfolio, one that's not betting heavily on any single commodity cycle. For a retiree drawing a quarterly check, that's a more reliable engine, not more exciting, more reliable. And in retirement, reliable is what pays the bills. So now you know what changed and why the new lineup is actually more durable for income investors. But here's the question that probably matters most to you. How does any of this affect your actual paycheck?
Most videos talk about holdings and sector weights and then move on. But if you are retired, the only number that really matters is this. How much income is this fund going to send me? Here is the answer. The post-reconstitution yield on SCHD is holding steady at approximately 3.5 to 3.6%. The reconstitution did not cut the yield. It repositioned the portfolio underneath that yield to make it more durable. Let me translate that into real dollars. If you hold $200,000 in SCHD, you are receiving roughly $1,750 per quarter. On $300,000, that is approximately $2,625 every 3 months. On $500,000, it is around $4,375 per quarter, more than $17,000 a year, landing in predictable quarterly installments. And here is what makes those numbers sustainable going forward. The new holdings carry an aggregate payout ratio of approximately 58%. That means for every dollar these companies earn, they are paying out 58 cents in dividends and keeping 42 cents as retained earnings. That is a healthy, conservative ratio. There is real breathing room to absorb an economic slowdown and still keep the dividend intact and growing. Think about what that means in Carol's situation. She is not just getting a check today. She's getting a check that has been structured to keep arriving and to grow over time. SCHD's 5-year dividend growth rate has averaged around 11% annually. At that pace, a 3.5% yield on cost today could become a 6% yield on cost within 8 to 10 years. That's the compounding engine most people miss when they only look at the current yield. Before I show you what this new portfolio has actually done during a real market downturn, drop a comment right now. Are you holding SCHD in a taxable account, a Roth IRA, or a traditional IRA? I read every single comment, and honestly, where you hold SCHD matters significantly for your actual after-tax income. That's a full video we are building for you very soon. Drop it below. Now, let us look at the test that matters most. Not the yield, not the sector weights. The test of what this portfolio actually does when the stock market falls. Because that's where SCHD earns its place in a retirement portfolio.
Look at what is happening in the market right now. Oil above $100, the Fed holding rates steady while inflation stays elevated, the S&P 500 down nearly 5% for the year, the Nasdaq down more than 32%. Sound familiar? It should. This is a very similar environment to 2022. And 2022 is the year that tells you everything you need to know about owning SCHD in retirement. During the full year 2022 bear market, with inflation at a 40-year high, the Fed raising rates at the fastest pace in decades, and growth stocks in freefall, SCHD fell just 3.2% for the entire year. The S&P 500 fell 18%. The Nasdaq fell more than 32%. More importantly, SCHD's dividend actually grew that year, not stayed flat, grew.
The income investors were counting on did not waver for a single quarter. In 2026, with that same turbulence returning, SCHD is already up more than 10% year to date. That is not coincidence. It is the quality filter doing exactly what it was designed to do. The reconstituted portfolio strengthens that track record. Healthcare companies, now a larger portion of the fund, are among the most recession-resistant businesses on Earth. People do not cancel doctor's appointments when the economy slows down. They do not stop buying medications. Consumer staples companies like Procter & Gamble generate steady revenues through every economic cycle because people still buy soap, shampoo, and paper towels in a recession. And enterprise technology companies like Qualcomm and Accenture operate on long-term contracts that do not evaporate in a downturn. This is a fund that was just rebuilt by its own rules, not by anyone's opinion, to hold up in exactly the environment we are walking into. Carol, the retired teacher from Ohio, does not need to panic. She does not need to sell. She does not need to call her daughter again. Her quarterly check is coming from a stronger, more diversified set of businesses than it was 6 months ago. Her income engine just got a tune-up. That is what smart, prepared retirees understand about SCHD. It is not just an ETF you buy and forget. It is a discipline, a system. Every March, it removes what has weakened and replaces it with what is built to last. That's the edge most investors never talk about. SCHD doesn't guess which stocks will win. It just keeps replacing the ones that stop earning their place. If someone you know owns SCHD or has been thinking about it, share this video with them right now. It could save them a lot of unnecessary worry. And a worried retiree making emotional decisions with their income is something none of us want to see. Drop a comment below. Are you already holding SCHD, or are you still building toward your first position? I genuinely read every comment, and this community is full of people who are asking the same questions you are. If you're building retirement income and you want to stay ahead of every change that affects your paycheck, subscribe to Dividend Hustle. That is exactly what this channel is built for, nothing else. Next, there's an ETF right now paying over 10%, and thousands of retirees are piling into it every single month. But there is one thing almost none of them realize until tax season, and it costs some of them thousands of dollars. That video is coming up next.